Hi, everyone. Welcome back to the InvestBall podcast. Today's guest is Jared Dillian. Jared is an ex-trader at Lehman Brothers. He has now published several books along with a widely read newsletter called the Daily Dirt Nap. And as a fun fact, Jared in his spare time is also a DJ. You can check him out under his stage name, DJ Stochastic. Jared, thank you for coming on today.
Hey, thanks for having me.
So I know you have a very widely read newsletter. I was checking some of it out before this. You have some interesting takes on the market right now. I'm curious to pick your brain as a starting place around the private equity bubble that you've been talking so much about.
Yeah. Private equity made a lot of sense when interest rates were zero and you could buy companies at 4 or 5 times. And, starting in about 2009, that worked for about 10 years. And it worked very well. And the funny thing about markets is that trades with high Sharpe ratios tend to attract sponsorship. So it got very crowded. We have 17,300 private equity firms in the US. There's a lot of competition for deals, and now you're buying companies at 10 or 12 times, and you're borrowing at 6 to 8% to make that happen. So it's what made a lot of sense in 2009 doesn't make a lot of sense today. And there's an enormous amount of leverage involved. And there's no exits these days. There's no IPOs. There's no acquisitions. And, if you buy a company at 12 times earnings, it's kind of hard to sell it at 16 or 20 times. There's no appetite for that. So really what I've been trying to think of is what is the catalyst going to be for all of this to unwind? And I really don't know what the catalyst is going to be yet. But we've reached levels of absurdity where Tony Robbins writes a book about private equity and, which was basically an advertorial for this PE firm that he's working with called CAZ, and he's trying to get individual investors into private equity. Kim Kardashian, Caleb Williams, there's just celebrities and athletes all getting into private equity. It's usually the stuff you see at the top. So, yeah.
It's almost, you could liken it to like the SPAC craze a few years ago, where you have a bunch of non-investors coming in, thinking they're like the next prolific investment mind and taking all these companies public via SPAC. Do you liken it to that?
It's very similar, although the SPAC craze was over pretty fast. I mean, that was over after a couple of years. This has been building for 15 years. And I mean, it's an $8 trillion industry. And this is going to affect real people. I mean, there are pension funds and endowments that have up to 30% of their assets in alternatives. So the ripple effects of this, when it unwinds, it's going to affect everybody. So
we've seen it in the VC market as well. There's been obviously that big cool that's happened over the past couple of years, and a lack of funding coming to the market. It seems like the VC space is somewhat rebounding now. I'm curious, do you think if like the Fed starts cutting interest rates, would that alleviate a potential downturn in the private equity market outside of essentially the bubble with all these other names coming in that probably don't warrant being in, but more so like the more sophisticated companies like a Blackstone or something? If we do have a cut of interest rates, if that will then continue on and have a soft landing in that market?
Yeah, I mean, interest rates are going to get cut for sure. I mean, we're going to find out more about that at Jackson Hole. I think the Fed is going to cut rates less than most people do. I think it's going to be at most 100 basis points over the next year. Even Patrick Harker today said that they want to do it very slow and very methodically, and so unless there's some sort of crisis, I don't see them cutting 200 or 300 basis points. So, I mean, yes, in theory, it helps private equity, but you're not getting back to the days of zero interest rates, So I think the positive effect is going to be pretty minimal. And if you look at the charts of the stocks, they really have limited upside. I mean, they've been going mostly sideways to slightly higher over the last year. So I don't think the market is pricing in really big positive effect from lower interest rates.
Fair. And I think that lends itself to the tightness of breadth in the market as well. Um, I know, like we saw the big, you've spoken about it as well, but the spike in the VIX over the past couple weeks, which looks like it's tailed off, but is ringing, alarm bells. Do you think there'll be a big market pullback, or is it more of a unwinding of these concentrated positions of like the Magnificent Seven into smaller and mid cap names?
I think there's going to be a reasonably big market pullback. I mean, what we saw was we still have enormous risk appetite. After that market dislocation, the S&P was down like 8%. Everybody rushed in to buy the dip. Retail investors across the world, and we ended up back up in the highs. I think as of today, we're starting to go lower again. Yeah, I mean, I think risk appetite is very high. I think we're due for a significant correction, at least 10%, maybe 20%. I would say 20% is a good number. That would shake a lot of people out. So,
Yeah, the way that I've always looked at it is looking at like the S&P equal weight over the S&P, which has been so concentrated. The S&P has in tech concentration for the most part. Do you see more like money not necessarily leaving the market, but going to more into like a wider breadth, going down market cap now?
well, that actually happened for a period of a couple of weeks. July 11th, there was a CPI number that came out that was a bit softer than expected, and there was a huge rush into small cap. And I don't know if you remember July 11th, but that was the day that the Russell was up 3.5% and the S&P was down 2%. And it was multiple standard deviations of outperformance, which had happened only a handful of times in history, one of them being the crash of 87. So for a period of a couple of weeks, you actually had decent inflows into small cap, and you did have a broadening in the market. That's pretty much stopped. So I think for sure, I think that could happen again.
Yeah, it'd be very interesting to see just since, I mean, ever since COVID, it seems like the Russell really hasn't participated at all. And I wonder what that is as a result of. I wonder, relating back to your PE point, if the asset allocators out there would unwind some private equity positions, like their alternative sleeve, and start investing back into small caps again for more like direct exposure.
Well, I mean, talking about endowments and pensions, their allocations to listed equities are at all-time lows. I want to say it's like 12% or something like that. Like listed equities make up just a freakishly low number of their holdings. Um, and that's got to go up over time. So for sure.
So with a market pullback, I know you've spoken about this on another show. You're bullish on commodities, if I have that right.
Yeah.
Do you believe that this is like a new super cycle developing in the commodity market, or it's more like a short term trade?
I do. It's a very complex question. It's with a very complex answer. Commodities have been very cheap for a while. Um, there are periods of time in history when commodities are the only thing that works, like the 1970s. 1970s, the stock market was a horror show, the bond market was a horror show, but commodities actually did reasonably well. And I look at things from a sentiment standpoint, and in terms of retail interest in commodities, like I've never seen it lower. The stock market is the only game in town. And beyond that, like now the bond market is interesting because you're getting, positive yields. So nobody really cares about commodities at all. And I think that's reached a low point. Getting back to what we were talking about earlier, which was if we had some sort of event that caused us to cut rates significantly faster and more than expected, you got 300 basis points of rate cuts. I think you would see the big commodities indices go up 20 or 30% for sure. So there's always the potential for that to happen.
Would that be broad based commodities or more like base metals or precious metals?
No, I think that would be broad based. I think that would be across the whole basket. I mean, if you look at any major commodity index, it's mostly gold and oil, mostly oil. Gold and oil make up about 40% of the index. And, beyond that, you have copper and stuff like that. But no, I mean, agriculture, livestock, softs, like it should all participate.
Interesting. And do you think that would there's a variability within that call based on the election as well? Like oil necessarily won't have a bull run if Kamala gets reelected or elected per se.
Honestly, I think if she gets elected, oil will have a bull run. But just in the last week or two, it's been collapsing. I think it's trading about 73 right now. I think oil has a bit more downside before it starts to get interesting. I'm looking at it. If you can get it into the 60s, I think it starts to get interesting. Um, so
Okay, very interesting. Yeah, I have to spend like a normal retail investor probably a little bit more time looking at the commodities market now because it's been an area I used to pay attention to, but now I just find with all like the negative news out with like ESG and whatnot that participating in like an oil sector or the oil commodity is very difficult when the governments are trying to counteract that effect.
yeah,
Uh, Changing gears a little bit, I know you're out with a new book, How to Live a Stress-Free Financial Life. I'm curious, part of the content of that book, you talk about the relationship of time versus money, and getting that relationship right is key to building wealth. Could you expand on that a little bit on what you mean behind the relationship between time and money?
yeah. You know what people have the relationship between time and money totally backwards? Criminals. Criminals have it totally backwards. Let me tell you a story. So this is like 10 years ago. This is when I moved into my last house. And I literally was in the process of moving. We're moving boxes inside, and a police car shows up, and this officer comes out, and I'm talking to him, and he's asking me questions. He said there's been a bunch of burglaries in the neighborhood, and he asked if I had seen anything. And I said, look, man, I'm literally just moving in. I just got here. But thanks for letting me know there's, thieves in my neighborhood, So um, anyway, a couple months later, they caught the guy, right? And what this guy was doing was there's a lot of rental houses in that neighborhood. So he would look at the rental house listings online. He would look at the photographs and he would see if they had TVs, and then he would go steal their TVs. So this guy stole 24 TVs in that neighborhood. Okay. Stole 24 TVs. And you got to figure, like, if you have a hot TV, what are you going to be able to sell it for? Maybe $200, right? So 24 nights out of his life to steal 24 TVs with the risk of going to jail to make $200 a piece. He makes $4,800. He would have made more money if he just got a job,
Yeah.
right? Like over the course of a few months of doing this, if he had just gotten a job, he would have made way more money. And eventually he got caught and went to jail for 8 years, right? So like you cannot make more time. You can always make more money. If I lose my wallet, right, and I have like $300 of cash in it, I don't care about the cash, the $300, whatever. Like, I don't care about it at all. What I care about is I have to go to the DMV and get a new license. I have to cancel all my credit cards, get new credit cards. It's just like, it's an enormous time suck. It's like 10 hours worth of work.
Yeah.
And I don't have 10 hours. I have money, but I don't have time. Right. And you always have to prioritize time over money. So that's one of the themes of the book.
So do you think the younger generation specifically gets that out of whack where they're always seeking higher and higher pay now at the sacrifice of more time spent?
That's a good question. I don't know. I really don't know the answer to that question. I mean, I teach at the university level, but I don't really know. I don't really have a handle on how they think about that. Um, so
Yeah, it's interesting because now there's such a hustle culture out there where everyone has to go. I mean, I'm kind of doing it as well, and you've done it as well, launching your own company and all the big time sink spent doing that with the potential for a massive upside in the future, but maybe not. And maybe you end up burning years and years of your time trying to launch something that doesn't end up panning out to be anything. Um, so I feel like a lot of people have been geared to, myself included, to think money, money, money instead of, like the European mentality of enjoying your life and potentially taking a lower paying job to have that work life balance.
Well, I don't really, I'm not a real big work life balance guy. I work all the time. I work because it's fun. I enjoy working. Um, there's, especially when you're young, like I'm 50, okay, so I've like taken my foot off the gas a little bit. But when you're in your 20s and 30s, you're in growth mode and you should be working as hard as you can to make as much money as you can so you can relax later in life, right? Like the whole work life balance thing for somebody who's 24 just doesn't make any sense. Like that's the age at which you're supposed to be working until midnight and, coming home and, crashing in bed and doing it all over again the next day. So,
Very true. Um, so with that, I know in another part of your book, you talk about how you split finances with your spouse. I thought it was a very interesting topic. Could you elaborate a little bit more on how you and your wife think about finances?
yeah, so we basically keep our money separate, like totally separate. She has her money, I have my money, which is a little bit ludicrous because I have 93% of the money and she has 7% of the money. But literally like on expenses like heating bills and water bills and insurance and stuff like that, we split it 93-7. Like according to how much we make. I actually make 92.7% of the income and she makes 7.3% of the income. So when we get the mortgage bill, I pay 92.7% of it. And then I have a spreadsheet and we keep track of how much principal we own in the house, right? And you might say, this is a huge pain in the ass. Why do you go through this? The reason we go through this is so we never fight about money. I can guarantee you, if you keep your money separate, you will not fight about money. If you combine your finances, maybe you won't fight about money, but maybe you will. And the reason is that people do this mental accounting. They say, well, I put $500 in the joint account. She put $300 in the joint account. Therefore, this is my money and this is her money. And she's spending my money on stupid crap. And this is how people get into arguments. So, like my solution isn't necessarily prescriptive. Like if you have a system that works, like if you have joint accounts and it's working, then that's fine. If you're not fighting about money, then I don't care. Like if that system works for you, that's fine. But if it's not working, if you are fighting about money, the way to take care of it is to keep everything separate. And I've been married for 27 years. I just had my 27th anniversary. In our entire marriage, we have never fought about money, not once.
How do you treat knowing that you are essentially the breadwinner, gifts and whatnot? Like your wife wants a new handbag or to go on a trip. Are you guys splitting that 93-7, or is that more on the gifting side is just more like a luxury that you award your family?
It's funny because we're kind of going through that right now because I just moved into a new house 3 months ago and it's a big house and we need lots of art, right? And she doesn't care about the art. I care about the art. So I'm the one that's buying all the art and that's fine. Trips, we have, vacations, we have split, like I'll take care of the airfare. She'll take care of the hotel or vice versa. Like we'll split it up in some way that's fair. Gifts, gifts are unconditional. Like if I buy her a piece of jewelry or something, it's completely unconditional. But yeah.
Interesting. So tying this back for the retail investor, I'm curious on your approach for, I'll call it like a more basic retail investor, on how they should treat, not necessarily on the splitting of household income, but on their investment side, Are you a proponent on index investing? And I know you come from an ETF background, so investing in those sorts of funds, or more so playing into macroeconomic themes, being able to identify potential risks in the market or opportunities in the market and exploiting that?
I'm not really a fan of index investing. And the reason is it's hard to mitigate your risk. If you invest in an index, you get the returns of the index with like the S&P 500 are very good. Those are great returns. But you also get the volatility of the index, right? So you're experiencing all this volatility. So volatility and risk are the enemy. Like that is it. I am very focused on investor psychology and volatility, the purpose of volatility is to make people make stupid decisions, right? So whatever you can do to mitigate volatility, and a lot of that is as simple as going with active management, right? If you have somebody, not necessarily like a large cap growth manager, but a small cap value manager or something like that, like there's a lot of things they can do to mitigate volatility. First of all, they can have cash. Like any mutual fund can have up to 5% of cash. So people say cash is a drag on returns, but it's also a drag on volatility. But there's a lot of other things you can do.
Would you have any advice for someone just starting out on what in your mind, an idealistic investment strategy would be to deploy if they don't have all the time in the world to research individual securities?
Well, in my book, in No Worries, I talk about the awesome portfolio. And the awesome portfolio is 20% stocks, 20% bonds, 20% cash, 20% gold, and 20% real estate. And in a sense, it's kind of passive. You do have to rebalance it once a year. But this portfolio returns 8.1% a year with half the volatility of an 80/20 portfolio and a max drawdown of 12%, right? And you can do it all with ETFs, low cost ETFs. So there's not much in the way of fees.
Okay, interesting. So, like picking a real estate ETF and picking like a gold commodity focused ETF to own.
Yep.
Okay, very interesting. Does that tilt? Does that awesome portfolio tilt based on age at all? Like, would you go more heavy into stocks in like your 20s and
Nope,
more into gold?
absolutely not. It stays constant throughout your whole investing career. Yeah.
Oh, interesting. So you don't prescribe to asset allocation dependent on risk at all? It's just agnostic of who's investing?
Well, I mean, I think if you had a target date fund, right? Like, I think if a target date fund goes from 90/10 to, 50/50 over the course of 40 years, like, I think that's totally fine. But the awesome portfolio isn't really set up that way. So,
Okay, interesting. Yeah, I've after spending a lot of time in the investment advisory world, that's I haven't. I should take a look at the awesome portfolio. Everything we've been gearing up towards is around obviously like that. We'll call it like a 90-10 split when you're younger, like more risk on, and then flipping that up and probably doing like 20% equity, 80% bonds when you get to a more seasoned age. I'll call it.
yeah.
Um, Okay, Jared, this I thought it was a very interesting conversation. If anyone's interested in learning more about all the books, but all the content, the Daily Dirt Nap, what's the best place they can find you?
The newsletter, the Daily Dirt Nap, is dailydirtnap.com. I have a personal finance company. It's called jareddillianmoney.com. You can go there. By the way, No Worries actually isn't my latest book. I have another book coming out in about a month. It's a short story collection. It's called Night Moves. So that's up on Amazon right now. You can pre-order it. So
Oh, very interesting. Is that personal finance related as well?
no, it's a short story collection.
Okay, very interesting. So very different than your previous content.
Yeah.
Interesting. Fiction based?
Yep.
Okay, very nice. Okay, we'll leave a link to the show notes for anyone who's interested in checking that out. Jared, thank you so much for coming on today.
Thank you.